We saw in the first example that companies can open themselves up to significant transaction gains and losses from dealing in foreign currencies. So this example is going to show you what happens if you get involved in some hedging. They're only going to hedge on the payable side here. So we'll have a couple of different things to look at, right? The other thing that you will need to keep in mind is the revaluation of receivables and payables when you cross year end, right? So here we're going to cross December, and December 31st is their year end. So we need to do some revaluation that we didn't do before. Each of these transactions will keep the transaction, the purchase side, the expense, and the sales sides separate from what's happening with the currency. So you're seeing transaction gains and losses to deal with the revaluation of receivables and payables, and the purchase and sales dollars don't change. Right? We have a situation in December 1st where we're purchasing merchandise from a manufacturer in Hong Kong, but we don't have to pay for it until April 1st. So that's a long period of time to just kind of hope that nothing happens significantly in the currency area. So they've decided to enter into a forward contract that will allow them to buy 210,000 Hong Kong dollars for this fixed rate on April 1st. The second one, we're selling merchandise to Zintel Realtors, and the price is 120,000 Hong Kong dollars. They don't have to pay for 90 days, and we didn't hedge. So we have exposure here to changes in the price of the Hong Kong dollar versus the US dollar. They received on April 1st the 120,000 Hong Kong dollars. We'll look at the table down below in a second. And then on April 1st, they also pay off their 210,000 Hong Kong dollars owed for the purchases they made, and also settle up the forward contract. Okay, so we have two sets of rates. The spot rate is the rate for the currency at each of those dates. No hedging, nothing unusual involved. Just that's what it is at December 1st, 29th, 31st, and April 1st. On the next column, we have the forward rates. So on December 1st, the rate for an April 1st delivery was 0.1314. Then by December 29th, it changed to 0.1305. And by December 31st, it was 0.1308. The spot rate and the forward rate there is no more forward contract after April 1st because that's the due date of the delivery. So the 0.1430 is what the exchange rate is by the time the payment had to be made. So we'll see that if the company hadn't engaged in a forward contract, they would have had a loss for the difference between the 0.1265 and the 0.1430. At the bottom of this example, I've included the pages in the text where you can run through another example so that you can see how all this flows again. Right, when we're recording the purchase on December 1st, we're using the spot rate right here times the 210,000 Hong Kong dollars. The second piece is the new piece. This is because of the forward contract they agreed in, they're hedging in this instance. So the forward contract receivable is for 210,000 Hong Kong dollars at 0.1314. Or 27,594. And that's what they have to pay to the exchange dealer to get the 210,000 Hong Kong dollars on April 1st. Right? In December 29th, there's an account receivable for 120,000 Hong Kong dollars. The rate, if you look up in the table, the spot rate is 0.1240. So that's where the 14,880 comes from. There's no no type of hedging going on with this. So that's it for the 29th. On December 31st, despite the fact that there was no transaction, we have to go and revalue the account payable, the forward contract, and the account receivable. So whatever is going to carry over into the following period, we have to evaluate as of the end of the calendar year, or whatever your year end would be for your company. So for the accounts payable, if we go back up here for a second, we see that the rate is now 0.1259 and it had been 0.1265. So 210,000 times 0.1259 is 26,439 versus the $26,565 we recorded up here. So that's debit payables to reduce it and credit a transaction gain. On the other side, the forward contract receivable, and what happened to that is we had the 0.1314 as of December 1st. Now it's dropped to 0.1308. So for us, that is a loss. And doing the math, you come up with 126, and it offsets the gain on the payable, but that's not necessarily always going to be the case. Right? Then the account receivable, we went from the 1240 to the 1259, and so that gives us a gain here of 228. Okay, so we're talking about this receivable here versus what it would be in Hong Kong dollars by the time, US dollars rather, by the time we got to 2 days later at the end of the calendar year. Right, then we go into the next year, okay, and these transaction gains and losses would be reflected in the income statement, and then we'd use the receivable and payable numbers we had at year end going forward. Right, when on April 1st, when we received the cash for the receivable, the Hong Kong dollars of 120,000 in terms of US dollars were 17,160. The account receivable total was only 15,108, the original plus the adjustment we recorded here. So we made out on that $2,052. But you can imagine if we're making out on the receivable side, if we had not done any hedging, we would have had the opposite impact on the when we were purchasing and we're on the payable side. And that's what you see next. So the dollars we would have had to pay to satisfy the 210,000 Hong Kong dollars would be measured at 0.1430 as of April 1st. So that's $30,030. If you go back and look at the balance in the payables, it was only 26,439. So the payable increases, and that's a transaction loss. But luckily, we had hedged, so we also revalue the foreign currency the forward contract receivable from the exchange dealer, the difference between where that stood at December 31st and the 30,030. So we were able to offset some of the transaction loss because we had entered into this forward contract. So the 2562 offsets at least a significant portion of the 3,591. And then to just close everything out, we have to pay the exchange dealer $27,594 in cash to get the Hong Kong dollars. The investment in the forward contract is equal to the value of the forward contract receivable from the exchange dealer. So we wipe that out and record it as an investment. And then when we pay out the amount to the company we're buying it from, we settle up the $30,030 payable, and get rid of the investment in foreign currency. And right here is the information about the pages in the chapter that give you something very similar. So hopefully that's helpful. The idea of getting involved with forward contracts and other hedging tools is to protect your position when dealing with foreign currencies over a couple of months or a period of time where they might be subject to a lot of change.